Hi, folks, and welcome to our Thursday evening members training session where we have started a series on advanced price action technical analysis. We're running through a lot of the material that is already in the academy. So, for those of you who've been through this material already, it should hopefully be a good reminder. And for those of you who haven't, it's coming up. So, I'm sure you'll get to benefit out of this. I'm also going to be highlighting a couple of key points that's in the training over here. So please do pay close attention. Now, obviously, our Thursday evening training is normally reserved for members, but I have noticed that amongst our membership, not everybody is subscribed to the YouTube channel. So please avail yourself of that. Make sure that you subscribe. And if you don't mind hitting the like button as well, and also hit that notifications bell because we are bringing out updated training all the time. We, for instance, did a live trading yesterday, which is a very valuable training exercise. If you haven't seen that, then please do make sure you go back and have a look at it. Right, so yeah, also, as I say, if you're getting value out of this stuff, please do hit that like button. The other thing to note is that this is the second of the series. If you haven't had a chance to go and watch the first video that we did last week, the training on the introduction to technical analysis, it's very important to have covered that because we look at the why behind technical analysis, and most people get that wrong. If you've got that wrong, you're starting off in a position where, unfortunately, you're doomed to fail in your trading. It's that important. So really do go back and watch that previous training. Okay, so what are we looking at today? Well, I'd like to jump slightly ahead and look at the life cycle of the market. We've already spoken about the purpose behind technical analysis, and that it first and foremost is there to help us identify where we are at in the life cycle of the market, so we are able to identify whether the conditions are appropriate for the particular trading strategy that we are looking to apply. So this is a big mistake a lot of people make, because they don't fully understand what the conditions are that need to be met in order to have a chance of trading a strategy successfully. You've noticed, I'm sure, as well, in our strategy training that we do specify what these conditions are. So for those folks who are Academy members and are learning our strategies, there should be no doubt, absolutely no doubt, as to what the appropriate conditions are for any one particular strategy. But that being said, the ability then to actually evaluate those selection criteria or to answer those selection questions is another story altogether. And in order to be able to do that, you really need to know what the life cycle of the market looks like. And then secondly, of course, probabilistically be able to identify where we are at in that life cycle. So what I'm going to do right now is just show this quick 3.5-minute video. It should also serve as a good reminder for some of you before we jump into some more important, or some points that I really want to highlight in this training before we can move forward. All right, so let's get this going here.
Okay, so the next thing we need to just talk about briefly is what the life cycle of the market looks like. We've already identified that there are two primary market conditions, ranging and trending, and they are mutually exclusive, which means that if you have been able to, using our methodology, identify that the market is ranging, it means it's not trending. And likewise, if you've been able to identify probabilistically that it's trending, it's not ranging. The question, of course, is where is the transition between the two? And as I mentioned before, we look to identify the start of a trend, which is this point over here, which I generally call the point when we have a potential trend. And we will talk about that in more detail when we get to that point. But bear in mind for the moment that a potential trend is also treated as the start of a trend. Now, that doesn't mean that it will end up being an established trend. It can, but sometimes it doesn't. If a potential trend does not end up being an established trend, we would call that a false breakout. But the main point, as you will see going forward, is that we will identify the start of a trend at a point where we have a breakout from the range. And that would be when we have this transition from ranging to trending. Then we get the different types of trend, strong, weak, and the different parts of the trend, and that we will delve into some of that today. But also bear in mind that when a trend comes to an end, it happens when we have a breakdown in the sequentiality of cyclicity. Now, you might notice that those two things, the breakout of a range and the breakdown of the sequentiality of cyclicity, are directly using each of the two elements of price action. The first element of price action, I generally consider to be support and resistance. And if you're in a range, well, your range boundaries are defined by a resistance level at the top and a support level at the bottom. And when you have a breakout of the range, it means that one of those levels has been broken. And that means that we are using the support and resistance element of price action to identify the transition from ranging to trending. However, conversely, when we identify the end of a trend, it's when we see a breakdown in sequentiality of cyclicity, which means we are now using the cyclicity element of price action in order to identify the end of a trend and therefore the start of a potential range. We will talk about the other options at a later stage, but just for now, remember that ranging conditions are one possibility that we assume, but we could immediately get a resumption of the preceding trend, or we could get a reversal. We call that the 3 R's, and we'll get into that in another training session. But nevertheless, for now, the main thing is to recognize that the transition from ranging to trending is where we have a breakout of the range, and when we have a transition from trending to ranging, it's when we have a breakdown of the trend, specifically the sequentiality of cyclicity of the trend.
Okay, so I hope that's all clear, but I want to point out that there's a very important topic that we've just raised here, and that is the two primary elements that make up price action. The one being cyclicity and the other support and resistance. Those are really the only two. And I often mention in my training that it's like building with Lego. The blocks themselves are pretty simple, but you can put some pretty interesting models together using Lego blocks. And it's simple as that as well with our elements of price action with those two particular elements. And we combine them in many different ways. But the one that I've raised here really is an important one because using those elements, we are able to identify probabilistically the transition between ranging conditions and trending conditions. Now, as you can see, those are the two primary classes of condition that we have in any market. And also, it's a very important classification between strategies as well. The difference between a trending strategy and a ranging strategy is absolutely fundamental. So if you can't tell the difference in terms of market conditions, that means that you're going to, of course, be applying your strategies potentially to the wrong conditions. And it's tricky enough to generate a positive expectancy, even if you are not making that mistake. So really essential to get that right. Now, when it comes to talking about these elements of price action and how we put those together, that is going to be the subject, starting with the next in our training series on advanced price action technical analysis. So once again, if you're not already getting notifications of our training as they come out, you must please make sure that you hit that notifications bell. Otherwise, you will not be notified when I bring out that next training series. All right, or next training video in the series where I cover the aspects of using price action in some detail. All right, so what is also very important to remember here is that if we are trying to take good trades, it is absolutely essential that we are able to identify the transition between these two types of condition. And the reason I say that is, well, just to illustrate it, I guess, is if you were to consider the possibility of being able to identify the start of any trend as it started, and then, of course, also the end of any trend as it ended, I'm sure you'd agree with me that it wouldn't take you very long before you were very wealthy. that is a dream that a lot of traders, aspiring traders, have. I'm sure you'll agree that you have often considered how nice it would be to be able to spot these moves that you always see in hindsight, but are never able to grab in advance. Now, unfortunately, it's just not possible because that is what we call the crystal ball syndrome. However, if you are able to identify the likely start of a trend as early as possible, and similarly, the end of a trend as early as possible, then you are much closer to that goal than most people ever get. And by using price action, we have absolutely found that it gives us a significant advantage over the market when identifying that conditions are transitioning, particularly in the beginning between ranging and trending. So we can start looking to apply our trending strategies. And then when those conditions start coming to an end, to know when to stop applying those strategies. So it's pretty close to be able to say, if it was a bullish breakout, we'd say, well, great, let's buy this market and jump into it. And vice versa, when we saw it breaking down, we'd be able to get out and take our profit. Now, that's not exactly how it works. For those of you who trade our strategy, know that there's a couple of extra levels that you need to understand, but it does come down to that pretty much. So even if we can't identify the exact beginning and ending of trends, we can actually get much closer than most people using price action. And that, I think, is really the key point. All right, so I'd like to illustrate this quickly using an actual chart. So let me just change the share I've got on this. Right, there we go. So you should be able to see this being the daily chart on the Euro USD, where for some time we were actually range bound. We had a false breakout. You heard me mention false breakout is one of the possibilities that you can have when you do get a breakout. The other being the establishment or the establishment of a proper trend. So what we had initially, just looking a little bit further back, is something of a false breakout here, with the market coming straight back inside of that range and then respecting its resistance level, until eventually we actually did finally get a proper breakout of this market. You'll also notice that we did have a trade in here, and this is because our selection time frame was actually on weekly, and the weekly time frame analysis helped us to identify that there was a potential resumption in the bearish trend on the weekly time frame, which is precisely what we ended up getting here. So now that breakout, as I mentioned in the trading video, gave us an indication that potentially we were looking at the start of a trend. Alternatively, as I mentioned, I like to call it a potential trend. There's a difference between a potential trend and an established trend, and we'll get to that in future trading. But once we have reason to believe that we are in fact in a trend, it allows us to drop down to an execution time frame and pinpoint our entries there. And we were able to do that very successfully, even though this was not an extended bearish trend at all. In fact, it came to an end within a couple of weeks of starting. And how did we know that? Well, we saw a breakdown in sequentiality of cyclicity in this area over here. And again, in future training, I'm going to show you exactly why that was a breakdown in that cyclicity. And cyclicity, of course, just to remind you, is one of the two elements of price action. And the start of the trend, as I mentioned as well, was with a breakout of the previous range. So we use the support and resistance element of price action to identify the breakout, and then we use the cyclicity element to identify the breakdown, start and end of trend. Simple as that. One of the important things in this technique is being able to close that loop, though, and identify where the next potential range is. Because if the trend has come to an end, it means we need to assume the first of the three R's. And the first of the three R's is ranging, and we have a number of techniques for that. And we're going to go into that in more detail in future training as well. But one of them is what we call the LPO range. And the LPO range was exactly there. So once we had that LPO range, we've now subsequently had a further breakout of this range, it has to be said, which has allowed us to drop down to lower time frames and look to trade this as well. Noteworthy, of course, is that we're coming up against this higher time frame resistance level. So this may well just be a phase 2 or corrective wave on that weekly time frame before we see a bearish resumption. But one thing we don't do as traders is second guess the market. So again, there was the breakdown over here, and then we had a breakout. For those of you who WM traders as well, I know you want me to talk about the fact that this was also a valid class 1W pattern, but that's also something that we'll get into later in the training series. But for now, just recognize that we did have that breakout yesterday with the outside close, and now we are waiting to see what happens. So never mind how we apply the strategies. For those of you who are trading different strategies, the point here is that you need to first and foremost be able to identify the appropriate conditions and select those conditions and none other before you apply your strategy. So I hope that's a decent example, a pretty simple one, where we've had a brief period of trending here on this time frame, but it's absolutely the case that we, even though it was a very brief period, we got several profitable trades out of this. It was quite a decent period for us on this instrument. All right, so folks, again, if you're enjoying all of this material, please do hit that like button and make sure you subscribe to our channel if you haven't done so already, especially if you are a member, this primarily being members training. It's really important that you stay up to date with our training as it comes out. So make sure you hit that notifications bell. If you've got any questions at all, then feel free. You can ask them now, or you can just pop them into the comments below, and I will answer each one of those myself. All right, so just a relatively short training period today, but this is a very important lesson for you to learn. So please make sure that you do go through that training module again. And if you haven't watched the preceding training videos, make sure you do that too. All right, folks, well, that's it from me for today. Short and sweet. I hope you enjoyed it. I'll chat to you all soon. Bye for now.